What's going on, guys? Today we're going to take a look at utilities specifically. But before we do that, I want to talk again about diversification and rebalancing the portfolio because I've been doing some thinking. And even though in my other accounts, I'm very, very aggressive right now into commodities, but I think that for the purpose of this series, it would be more helpful if I took a more balanced and diversified approach. So I decided that the weights of the portfolio would be 50% into cyclical stocks, which 40% of those would be into commodities, and then the other 10% would be in aerospace and defense and real estate. And then defensive stocks would take 25%, and sensitive stocks, in which I include the really high yield components of the portfolio for extra income at the cost of really high volatility and risk, would be 25% as well. So all in all, the defensive and sensitive sectors take 50% and the cyclical take another 50%. So that's what I'm going to aim for in the series. And here we see that in the commodities, I'm already at 40%, almost on the nose. So I won't invest in that this week. Cyclical stocks are over invested by 5%, and defensive stocks are under invested by 12%. So that's where, meanwhile, sensitive are at 6%. So defensive is definitely the category in which I should put my focus. And if I use my little system for reinvesting, and this is what I wanted to talk about, is that even though when we think of rebalancing the portfolio, usually it means selling a position to reinvest that money elsewhere. But since I'm dealing with very small amounts right now, all I need to do is to stop investing in the sectors that I'm over invested in and just redirect the money towards where I'm not invested heavily enough. So if I use my permission chart over here, it tells me that utilities is really the sector where I'm the least invested right now. So now I know the category in which I want to invest in. It's going to be defensive stocks for this week. And now I know the sector, which is going to be utilities specifically. So from there, let's take a look at the options that we have. So this is the S&P. If you want to take a look at the utilities of the S&P, the sector is called XLU, and this is the performance since the 2000s. So you see that it's a less volatile sector, and you're going to get less performance than the S&P, but you have a lower beta. So meaning beta means that in simple terms, it means that your volatility is a bit lower, or that you're not moving in sync with the market all the time. And it's with low beta stocks that you can create a diversified, more stable portfolio. And this is why I want to take a look at this sector, because in the defensive sector or category of stocks, utilities plays a big role, because these are things that people need for everyday living. So you need to pay your electricity bill, water bill, in order to or communication for your cell phone and things like that. So regardless of the economy or the state of the stock market, you still have to pay for your bills at the end of the month. So XLU, if we look at what it looks like as far as the dividend, it's a 2.67% compared with the SPY, which is at a little bit over 1%. So it's not anything big, but it grows over time, slowly but surely. The expense ratio is 0.09, so this is a low expense ratio for someone that wants a bit more stability. than the S&P right now. If you don't want to be into the tech stocks and things like that, but you still want to be invested, this might be a place where you might want to look. The biggest company in there is, as far as I know, the biggest company in the utilities space in the United States, which is NextEra Energy at 12.9%. And you have a lot of the majors over here that you can look on your own if you want to check out their dividends individually and see which ones would be interesting for your portfolio. But right now I want to invest in covered calls in the utilities sector. So what are my options? So one of the options is the Harvest Equal Weight Global Utilities Income at 7.87% yield. So this is interesting to me because it gives me exposure to a sector which is fairly defensive, yet I still generate over twice the income that I would get if I invested into XLU. But before I start investing, I want to ask myself the question, how does it pair compared to the index? So how does it do versus XLU? So we can take a look at HUTL. Compared, we're going to go to max right here. And as you can see, I'm losing a lot of total return compared to just investing in XLU. So there is a cost to investing into covered calls because you, when the market starts to go up, you get liquidated out of your positions of the stock, and then the person that's managing the covered call ETF needs to buy back the stocks, re-emit some calls on the stocks that they own, and this whole thing costs money, and it blocks you from participating in the most of the upticks of the market. So what are the other options? The portfolio manager can choose to use a bit of leverage in order to counteract that. And for that, you can go into HUTE, which is the same as the other one, but it has as a HUTL, but it is leveraged. So I'm going to remove HUTL here. And you can see here that compared to XLU, it's actually it has been beating the market by a couple percentages when you take into account the reinvestments of the dividends. So this is a total return, including the dividends. So when I'm looking for an ETF, a covered call ETF that reproduces another index, I'm looking for a little bit of leverage. Around 25% seems to be the sweet spot in order just to track the underlying. And sometimes you can tell here, if you look at this time in history, you can tell that the HUTE has been a little bit outperforming the market. It went down less if you include the reinvestment of dividends. It just seems to have a bit less volatility. But when the market starts to pick up again, like over here, then XLU will outperform still the covered call version of it. So that's one option. This one is for global utilities. But what are the other options? Let's say I want to turn towards Canada. Let's say XUT is the iShares S&P and TSX Cap Utilities Index for Canada. So let's add that to the mix. So this is the performance of it. As you can tell, it's been lagging behind the market, behind the global market, or US market actually, but it's still going up. So if we look at the dividend, it's at 3.76%. So that's interesting. for someone that is looking for a bit more income. And the dividend growth over the past 5 years has been 6.53%. So what this means is that if we take the rule of 72, 72 divided by the interest rate will give you how long it will take to double. So in this case, it would take about 11 years to double. So if I invest now at 3.76%, I can expect that in about 11 years, my yield will be double that on a relative basis. So it's still an interesting stock to own, an ETF to own. And now, what are the choices to reproduce that and bump up the yield even more? It would be HUTS at 6.42%. This one is, I believe it's not even covered calls, it's just a bit of leverage on utilities. You can check that out on their website, but these are there's like 12 stocks, I think, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 stocks in which they invest, and then they put a 25% leverage for an annualized yield of 6.38% distributed monthly. So I like the diversification of this one. You have some electricity based stocks, you have some communications in there, and you also have some pipelines as well, and gas. So it's well diversified, a little bit of leverage into a defensive sector in order to boost the yield. So that's an interesting choice. So that's all very interesting, but first let's take a look at the performance compared to XUT as the benchmark. So as you can see, it's been really close. I'm gonna remove XLU and HUTE. So it's following tightly the underlying benchmark, but not quite. But we have some additional income if we want to choose that. But I think the fees must eat up some of the returns as well. And so it depends on what you want. If you want more income than at the expense of a couple of percentages, then you can go with HUTS. And otherwise XUT is an option. What about other options? You could go with the UMAX, which is this one has covered calls on utilities, and these are the stocks that they invest in. Again, big companies. It even has some Waste Connection does the removal of garbage. You have CNR in there, which is a railroad. You have a bit of everything as well, so it's good diversification, but the yield is at 14.4%. But let's take a look at the performance, including the dividends. So as we can see here, it's a less volatile asset than the rest. It really goes down less than the rest of the market. So I like it as far as a diversification tool. Has low beta, and that's very interesting. But you're gonna pay the cost of lower returns. But as far as being something stable for income, that's interesting. But as you notice, at 17%, if you have a 14% yield over 2 years, that would mean that the price of the ETF itself would be in the negative compared to what you first invested in. So if you put $1,000, you would be down, I don't know, I haven't done the calculations, but at least 10% or so. So if we look at the chart here, as you can see, it's going down. So this is the price to pay, is that your base amount that you've invested is gonna go down as you receive some of that money back into your pockets. So it's not the 14% is not a total return on your investment. It's just you're going to eat up the capital a bit. So that's something to think about. To make my point a little bit clearer, you can see here that from the peak to the bottom, it has gone down 23%. To today's price, the share price has lost 20%. But if I add the dividends to the price here, decline, then this is what it would give me as far as total return. So you're getting positive total return on your investment, but it is not, your capital is being eroded away. So I think there's a balancing act between the high dividend and the price appreciation that needs to be reached. So I would not go 100% into UMAX. I would buy a little bit, but I would try to stabilize the amount that I have invested into utilities so that it doesn't eat up the capital, but just generates income based on the same capital or a slight growth of that capital. Another option is UTZ, Evolve Canadian Utilities Enhanced Yield Index, at an 18% yield, which is quite mouth-watering for this sector. But let's take a look at the performance compared to XUT. So this is the maximum that I have here for this one. So it's been vastly underperforming even over a small window. So that's something to think about. If you let's compare it to UMAX as well. Okay, so it's been outperforming UMAX. It's more volatile though, but this is another option for someone that wants extra income at the cost of capital depreciation over time. So what about other options to invest in utilities? The obvious choice is NextEra Energy, the biggest in the category, and it has gone through a very difficult phase over here, a consolidation phase, but these are often followed by very long uptrends afterwards. So that might be an interesting point to enter. I own some into other accounts of that single stock, and I will probably continue to add over time. So that's an option. You get 2.76% dividend yield. If we compare NextEra to the rest of the market, I expect that it will beat it over time. Let me remove a bit the old ones. So as you can see, if you compare with something that has a bit of data, it's not even in the same league. But because for several years it's been going sideways, then you might have an opportunity to buy it before it starts to go on a run. But I don't have a crystal ball. I don't know if that's going to materialize or not. So NextEra is an option if you like chasing. I'm not much of a chaser, but another one is Vistra. This one has gone up quite a bit, but the yield is uninteresting at 0.53%. But if you believe that it will continue its uptrend, this is one that's been very popular lately. Another one is NRG. Same pattern. It's been repriced basically. And one that I've invested in a while back is Canon. Ticker is KEN. This one follows a channel, so it's an interesting way to trade these type of cyclical stocks sometimes. If you find a stock that has a tendency to do cycles like this, then you can kind of time the bottom. I usually cut some of the position when I reach the middle range, and then I ride the rest until it becomes overbought at the areas above. Right now, for me, I would not reinvest in this because it's it's too risky for my personal taste. And another one is uh, GE Vernova. This one is going in a straight line, but it's doing a bearish engulfing pattern, and it seems to have capped out. But for someone that doesn't mind the risk, then this is another option that's been going up quite a bit. But that's not the goal of my portfolio. My portfolio is to build some income, and this one doesn't barely has a dividend, so it's not really helpful. But there are some options that I've been looking at right now. I think that Northland is very interesting to me to add in the portfolio. It says here at 6% dividend, but that's not true anymore because it has reduced the dividend by 40%. This one gives a monthly dividend, but it went from 10 cents a month a share to 6 cents. So that's a big drop. So it's at 3.87% yield if it stays that way. I personally like to invest into stocks that have been going down a lot, in which the dividend has been cut, because then you have the purge from the investors has really happened. You have the ones that are seeking capital appreciation are gone, and the ones that are looking for high dividends have gone as well for the most part. So as we can see, for the past 25 years, it's been going into a cyclical channel, basically, with the occasional overbought situation that we've seen, which often leads to lower prices. And now we've touched the bottom of the channel, so the support seems to be holding. So this is a very interesting option for me in order to get some both a dividend and price appreciation potential. But again, the price could go to zero. I don't have a crystal ball, but to me this is interesting. Another one that I've been investing in into other accounts is Brookfield Renewable Partners. This one has a quarterly dividend, but it keeps increasing it by about 5% a year. So that's an interesting one to look at, because it's going up and up and up over the past 15 years or so. Brookfield is a very renowned company for proper management in the sector. With a 5% yield, it's nothing to sneeze at, and if it bounced lately to the support, and it crossed that green line here, which was the resistance of that downward movement. So I'm expecting a retest of that support over here to and then slowly but surely going back up. So this is an interesting place for me, and even if it would go lower at the support again, I would purchase more of these shares, because I believe this is a well-run company that I could hold for the long term. So these are options. I personally have bought HUTE into the dividend experiment, the snowball experiment, but I will probably add the other ones as well that I've discussed today over time. It's a debate between going higher yield or higher potential for total profits. So this is something that I'll be looking at. But for now, I think I will start to I will buy Brookfield and Northland, just small positions, just to wet my beak and start watching the stock closely on the experiment. All right, so I've bought two positions in the Northland Power and Brookfield Energy Partners. So these are very small, so it represents 1.87%. I bought like $150, and Northland Power. So now this increases my utilities exposure to 5%. So I'm still a bit lower, but if we look at my permission chart for the next stocks that I can buy, there's energy in which it's getting a bit lower, but if we look at the categories, I'm already close to the 40% target, so I think it's more of a priority to increase my exposure to defensive stocks. So based on that analysis, consumer staples is the next buy that I will be doing next week. So I'll see you then.